The United States survives on borrowed money. Every year, trillions of dollars are lent to America. But what if one day the world says no more? Because right now, cracks are already forming. Exploding debt is a real concern for investors. Debt is piling up. And when a major crisis hits, the music stops. The real question isn't whether a crisis will come, it's at what point the bond market breaks. One of the most powerful weapons in China's arsenal is simple: selling U.S. Treasuries. In total, the United States now owes more than $34 trillion. That's comparable to the combined economic output of Europe, Africa, and South America. If this wasn't already a problem, the last few months have made it one. For nearly a century, the United States was the most stable economy in the world. Friends and rivals alike bought American debt, using it to secure their pension funds, sovereign wealth funds, and even their own currencies. The entire system was built on one assumption: the dollar would never fail. But what if that assumption suddenly changed? Since 2008, U.S. debt has tripled. Every year, America now needs to pay close to $1 trillion just to cover its existing loans. And year after year, each new budget piles on even more. For the first time in decades, a serious question has begun to surface. Can the United States actually afford all of this debt? Since 2021, China, once the world's largest holder of American debt, has reduced its U.S. Treasury holdings by hundreds of billions of dollars. And it's not just China, Japan, Britain, parts of Europe. America's long-standing allies have periodically reduced their exposure as well. And just when it seemed things couldn't get worse, a new round of tariffs sent global markets into turmoil. America is no longer the predictable, secure economy it once was. And while the United States is not about to collapse, if it stumbles under the weight of its debt, the damage won't stop at its borders. It could bring the entire global economy to its knees. America's future as the world's leading economy has suddenly been brought into question. But there was a time when even doubting the safety of U.S. debt would have seemed absurd. That's because for nearly the last 100 years, the United States functioned as the bank of the world. Whenever it needed money, all it had to do was issue debt. And almost every major country on earth lined up to buy it. Japan, China, and the United Kingdom each hold hundreds of billions of dollars in U.S. government bonds. They entrusted their savings to Washington. For them, this wasn't speculation, it was security. The U.S. government paid roughly 2% interest per year. Compared to U.S. stocks, that may seem insignificant, but there was a crucial difference. Companies can, and often do, go bankrupt. Countries rarely do. Pension funds, sovereign wealth funds, and government reserves all operate with taxpayer money. Money governments cannot afford to lose. And when it came to safety, nothing rivaled U.S. debt, because it was backed by the United States itself. But there was a flaw. This system of mutual trust only works when repayment is unquestioned. And there's an old saying, if the bank lends you $100, it's your problem. If it lends you $1 million, it's the bank's problem. Today, the United States owes more than $34 trillion. And that makes it everyone's problem. Things began to change in 2008. In 2008, the United States entered its largest recession in 80 years. The economy was collapsing. Banks were failing. Credit had frozen. Faced with a system on the brink, the government turned to the only strategy it had ever relied on: spend its way out of trouble. First came the Emergency Economic Stabilization Act. $700 billion were committed to rescuing collapsing banks. Then came the American Recovery and Reinvestment Act. This time, it was $831 billion. The money funded tax cuts, infrastructure projects, and direct relief for struggling Americans. These measures helped stabilize the economy. But they came at a cost. None of it was paid for. Every dollar was placed on the country's credit card. From 2008 to 2020, the national debt surged dramatically. By 2020, each citizen of the United States effectively owed over $90,000 in government debt. Under normal circumstances, this would have been alarming. But this was not a normal era. This was the era of free money. Interest rates on U.S. debt were pushed close to zero. Borrowing trillions of dollars cost almost nothing. And this wasn't accidental. It was the result of America's reputation as the world's ultimate financial safe haven. Countries and institutions across the globe were desperate to place their savings in the hands of the U.S. government. Demand for U.S. bonds surged. Interest rates fell even further. So, despite issuing trillions in new debt, the cost of servicing it remained manageable. For a time, the strategy appeared to work, but it carried serious risks. A rise in interest rates of just 1% would increase government costs by hundreds of billions of dollars per year. And there was another danger. If foreign investors ever lost confidence in the dollar and began selling U.S. debt, it could trigger a massive sell-off. The dollar would weaken, inflation could surge, but almost no one believed such a crisis was possible. In the eyes of investors, the United States was still solid, still reliable, still untouchable. Few imagined anything could derail it. Then, in that very period of confidence, another shock arrived: the pandemic. Once again, the government faced an economic freefall. And once again, it chose the same solution: massive spending. Trillions of dollars were injected into the economy at record speed. Stimulus checks, business bailouts, expanded unemployment benefits. The scale was unprecedented. By the time the dust settled, U.S. national debt had increased by several $trillion. That was an additional $15,000 per person added in just a few short years. After the pandemic, America's total debt crossed $30 trillion and continued climbing. For the first time since World War II, the United States owed more than its annual economic output. What once looked manageable was now accelerating out of control. And yet, the entire system still relied on the same belief: that the U.S. dollar was rock solid, the safest asset on earth. That belief was the reason countries around the world had entrusted their savings to the United States in the first place. But with debt at these levels, investors began asking a new question: could America actually pay it back? Just 1 year after the pandemic, the shift became impossible to ignore. China, the largest holder of U.S. debt, significantly reduced its holdings, amounting to hundreds of billions of dollars over time. Next came Japan, the second largest holder. It reduced its holdings by large amounts over multiple years. And in recent months, even America's closest allies, the United Kingdom and Canada, have begun to sell. Trust in the U.S. dollar had clearly been shaken. This wasn't the first time foreign sell-offs had occurred, and historically, the United States had always survived them. But this time, the context was different. Debt levels were far higher, interest rates were rising, and investors were growing nervous. The critical fear was simple: what if the United States had taken on too much debt? What if confidence began to unravel? The first warning sign would be rising interest rates. And that sign was already visible. The U.S. government now pays around $3 billion every single day just to service interest, the highest level in the country's history. If bond sell-offs continue, this burden will only grow. Over the next decade, interest payments alone are projected to cost each American citizen tens of thousands of dollars. Money that could have funded health care, Social Security, or tax relief is instead flowing to foreign governments and financial institutions. The United States has the largest military budget in the world, yet today even that is smaller than the interest paid on national debt. In the developed world, this is unprecedented. The U.S. currently spends nearly 1/5 of its tax revenue on interest payments, nearly double that of any other G7 nation. Countries like France and the UK keep debt servicing costs below 10%. Even Greece, a country famous for financial instability, spends only a small share of its tax revenue on debt interest. As confidence in the dollar weakens, this imbalance becomes more dangerous, but the consequences would not stop at government finances. A U.S. debt crisis would revive the very force that triggered panic in the first place: inflation. When investors buy U.S. debt, they must buy U.S. dollars. More demand for dollars raises their value. That strengthens the currency. But during a large-scale sell-off, the reverse happens. Foreign investors don't just sell bonds, they sell dollars. They exchange them for other currencies. As dollars flood the market and buyers disappear, the value of the currency falls. And this is where the real danger begins. America is heavily dependent on imports. Consumers import trillions of dollars worth of goods every year. That includes a quarter of all manufactured goods and nearly a fifth of the country's food supply. As the dollar weakens, imports become more expensive. Fuel costs rise, groceries cost more, electronics become pricier. The standard of living comes under pressure. Suddenly, the very factor that once powered America's growth, cheap credit, becomes its greatest vulnerability. While all of this may sound extreme, history offers warnings. And although the scale was far smaller, there is a modern example that shows how quickly confidence can collapse. At the turn of the century, Venezuela was the richest country in South America. Fueled by vast oil reserves, the nation appeared unstoppable. Its economy was booming. Its government was flush with cash. But beneath the surface, a dangerous dependency was forming. Venezuela relied almost entirely on oil exports. The government borrowed billions. As long as oil prices stayed high and investors remained confident, the strategy worked. Then the oil stopped flowing. Prices collapsed. And with them, investor trust vanished. Almost overnight, Venezuelan debt was dumped. The currency collapsed. The economy unraveled. Inflation spiraled out of control. People were forced to carry bags of cash just to buy bread. Nearly 20 years later, inflation in Venezuela has repeatedly surged into triple-digit territory. The country fell from extraordinary wealth to economic ruin. As devastating as this collapse was, a similar crisis in the United States would be something else entirely. The stakes would be exponentially higher. The U.S. is not just another economy, it is the backbone of the global financial system. A failure at this level would not remain contained. It could bring the entire system to its knees. For nearly a century, the U.S. dollar has functioned as the world's primary reserve currency. The pound, the euro, the yen, all are backed, directly or indirectly, by U.S. dollars. The logic is straightforward. If investors lose confidence in a country's currency, that government can use its dollar reserves to buy back its own currency. This supports the exchange rate and prevents a financial collapse. But this system relies on one critical condition: trust in the dollar. The moment that trust breaks, those reserves lose their power. The currencies backed by them become vulnerable. It's important to understand that this does not happen overnight. The dollar will not suddenly become worthless. But trust erodes gradually, and once it starts, the process is difficult to reverse. Today, that erosion is already underway. Tariffs, inflation, relentlessly rising debt. Each one chips away at confidence in the American system, and countries are responding. China is aggressively promoting the yuan as an alternative global currency. Other nations are increasing trade in gold, euros, and even digital currencies to reduce dependence on the dollar. As competing reserve assets rise, America's financial dominance weakens. And with it, the global balance of power begins to shift in ways not seen for a century. All of this leads to a critical question. Can anything be done to save America's position in the global financial system? There are only two realistic options left for the United States. Neither is attractive. The first option is to cut spending. By reducing government expenditure, the national debt could be slowed and interest costs brought under control. In theory, this is the responsible path. In practice, it is politically brutal. Politicians win elections by promising better services and lower taxes. They do not win by cutting government spending. Unsurprisingly, since the 1980s, there have been only 4 years in which the U.S. government ran a budget surplus. Every other year, the debt grew. Attempts to curb spending are often small, symbolic, or short-lived. Even high-profile efforts to reduce waste have barely moved the needle. The uncomfortable truth is that most federal spending is not bureaucracy. It is concentrated in massive, politically sensitive areas: welfare programs, Social Security, healthcare, the military. Without cuts to these big-ticket items, any attempt to rein in the deficit is destined to fail. Yet cutting them comes with severe consequences: social unrest, political backlash, economic slowdown. The second option is far more dangerous: printing money. The Federal Reserve has the authority to create an unlimited supply of U.S. dollars. In theory, this allows the government to print its way out of a debt crisis. But in reality, this would be economic suicide. U.S. debt has always been sold on one promise: that it is a rock-solid store of value, one of the safest assets in the world. If investors believe that the government will simply print money to cover its obligations, that promise collapses. Trust evaporates. The dollar begins to lose value. Inflation accelerates. Foreign creditors dump U.S. bonds en masse. Borrowing costs surge. This wouldn't be a mild downturn. It would be a full-scale financial collapse. The United States would effectively be breaking the contract with every investor, foreign and domestic, who ever trusted its debt. Faced with these choices, there is no easy escape. The debt crisis is not theoretical. It is already here, and the government is rapidly running out of options. While cutting spending is politically painful, it remains the only path that does not risk destroying confidence entirely. Whether the United States can summon the political will to take that path remains uncertain. While this crisis may appear financial on the surface, it is part of something far larger. America's debt problem is exposing a deeper vulnerability, not just economic, but strategic. The reliance on foreign powers doesn't stop at finance. It runs through the supply chains that support America's defense, energy, and technology sectors. One of the most critical weaknesses lies in rare earth minerals, or resources essential to modern industry and national security. The United States produces very little of them domestically. Take tungsten, a metal required for military-grade ammunition, aerospace engineering, and advanced manufacturing. Today, there are no operating tungsten mines in the United States. China, by contrast, controls a dominant share of the global supply. Recent export restrictions have demonstrated how fragile this balance really is. When access is threatened, entire industries become vulnerable. This has forced a strategic rethink. Major policy shifts are now underway. Efforts are being made to reduce dependence on foreign suppliers and rebuild domestic capacity. Because economic security and national security are no longer separate issues. They are the same. What happens in the bond market now echoes through supply chains, military readiness, and geopolitical power. This is why the debt crisis cannot be viewed in isolation. It is not just about budgets or balance sheets. It is about leverage, about trust, about who controls the foundations of the global system. For decades, the United States benefited from unparalleled confidence, the ability to borrow endlessly at low cost, to finance growth, wars, and crises without immediate consequence. But that era is being tested, not because the system collapsed, but because trust is slowly eroding. And when trust fades, power shifts. This does not mean the dollar will disappear tomorrow. It does not mean America will suddenly fall. But it does mean the margin for error is shrinking. Every new crisis, every new deficit, every new shock carries greater risk than the last. The question is no longer whether the system is sustainable forever. It is how long confidence can hold before something gives. And when it does, the consequences will not be confined to one country. They will reshape trade, currencies, alliances, and global power in ways we have not seen in generations. The debt crisis is not the end of the system. It is the stress test, and the outcome will define the next era of the global economy.